So good afternoon, test. Good afternoon, everybody. So I'm Armel Lub. I'm with STOXX. I will let my colleagues introduce themselves.
Absolutely.
Michael.
So I'm Michael Hurley. I'm working at Credit Suisse within the equity derivative structuring team. I'm focusing on the development of equity thematic indices, so encompassing ESG indices, especially indices that are used as the underlyings of structured products. And in the past, we have worked quite extensively with STOXX in that respect. I've been at Credit Suisse for 4 years, and before that, I worked at BNP in the equity derivatives department as well in the structuring team.
Johannes.
My name is Johannes Singerfurt. I work for JP Morgan here in London. I've been there for 4 years, and to keep it short, I do more or less the same thing as my colleague.
Hi, good afternoon, everyone, and thanks for having us. I'm Isabelle Mila, working with Société Générale, and I'm head of Sustainable Investment Solutions. So also working a lot on ESG indices, as well as sustainable structured products.
Over the past few months, or maybe a couple of years, I've talked to a lot of clients, issuers, investment banks about ESG indices to serve for structured products. Maybe first question for you, Isabelle. I was wondering whether you were seeing a lot of differences depending on the channels of distributions or the markets in terms of ESG strategies. I'm not talking about the products, but the strategies and the type of request that you get depending on the type of clients.
Sure. Let's maybe answer on country differences first, and then tackle the distribution. So regarding countries, and it was mentioned this morning, there's first the obvious cultural differences regarding exclusions. So, talking to German investors, there will be a strong attention on nuclear. Nordic countries will place more of a focus on fossil fuels, for instance. French investors tend to favor best-in-class strategies where they, promote best practices across sectors. So obviously that's a first difference. A second one is stemming from local regulations. And I know we'll come back to that later, so I won't detail, but of course we should hope for convergence towards EU standards. Then one last thing I'd like to mention on countries is, it was said that, and it's true, that Nordic or Northern European investors were pioneers in ESG for sure. And to this date, Northern European countries are still leaders. And to give an example, for institutional clients in Belgium, my sales force says, it's not even worth coming to them with a structured investment idea if it doesn't entail some sort of a sustainable filter. However, I want to mention that I've seen ESG adoption going, south in the good sense of the term. And to just, again, give one example, we recently saw a lot of success for a structured product in Italy, which was tied to a Sustainable Development Goals themed index, and which was also a positive impact note, which we call positive impact notes, which means that the invested amount supports positive impact loans originated by Société Générale. So it was really like ESG at all levels, and it did gain very significant traction with retail investors in Italy. So now for the channel differences or client type differences, well, I would say for your retail distribution, you really need to build an off-the-shelf offering, that will match clients' needs in terms of ESG themes, but also in terms of financial characteristics. So, your offering will be kind of a matrix. Whereas for institutional investors, a key word is about customization. So they will look at your off-the-shelf strategies, but then, there will be a lot of iterations and adjustment to their in-house ESG policies. Also, even if ESG should always be do good and do well, I've had a lot more questions from institutions regarding the potential of ESG to drive, long-term risk-return improvement. And then finally, obviously, more sophistication and, institutional investors ask a lot these days about combining smart beta, so equity factors and ESG, which is the kind of question you will not really see with retail.
Johannes, maybe you want to give your view about the US market or Europe as well?
I guess you kind of agree that markets are in different kind of stages when it comes to ESG investments. So I think if you look in Europe, you have the Nordics, which are among the most advanced, and now you have Italy and Spain and these markets coming into that as well. I've been asking my colleagues in the US and Asia how far they see this kind of transaction, and they see at least that they're a little bit behind that curve. So I started in this industry in 2015, and I remember back in the days, there was also in Europe not that much investment in ESG yet, and was a lot of people asking questions about it. And I think in the US, we're a little bit at this stage right now as well, where a lot of people are asking questions about it, are asking what kind of indices are available in the ESG kind of space, but the amount of trades, especially in the structured product space, are still relatively limited. The same in Asia. There's some trades in Japan, but we're still at a quite early stage. So I think the good news we can take away from this, as I think most people here in the room are Europeans, is that Europe managed to be the most advanced and the frontier market for ESG kind of investments.
Thank you. Michael, next question for you. We heard this morning already that regulation was helping the adoption of ESG strategies. Do you think, in general, it is the same thing in the structured product industry, or is there some kind of schizophrenia from the regulators?
So I think so far we've seen a lot of indices that were branded ESG, where basically the selection was quite light. So overall, the indices were, let's say, environmental friendly or ESG friendly, but in the end, for example, the best-in-class selection was very light. And so one of the main reasons for this is because the indices that are dedicated to structured products are not only built in such a way to offer exposure to ESG, but also, they are also built in a way to offer pricing efficiency when invested via derivatives. Mm-hmm. So typically embedding financial filters like selection based on volatilities, dividends, potentially correlation or others. And so there have been some regulators that have been looking at it quite actively and setting some, very strict rules for what, for an index or a product to be defined ESG. So I think the most advanced regulator with that respect is the Belgian regulator, where basically the FEBELFIN, which is kind of the banking association, has set some clear guidelines about the criteria that should be fulfilled in any equity ESG index. Mm-hmm. And so among the different criteria, there is a best-in-class approach where basically, for example, the index is screening, let's say, the top 30% stocks with regards to, let's say, carbon intensity. There are some norm-based screenings, like screening out companies violating the UN Global Compact principles, for example, linked to labor rights, to anti-bribery, corruption, to the environment, etc. And there is also an additional level of screening, which is based on, let's say, controversial or disputable activities. So typically involvement in, let's say, gambling, adult entertainment, coal, unconventional oil and gas can be seen as negative, and they are among the criteria that can potentially be used. And in the example of the Belgian regulator, they set very strict rules for products to be defined as, let's say, socially responsible. I think another good example is the French regulator. Maybe I will let Isabelle to speak a little bit more about this.
Sure. Yeah, very quickly, because I think regulation can be, a help or also a hurdle. And it's worth mentioning that example, which I think was kind of a good practice, both in terms of the process and in terms of the content. So the process was very collaborative. The French regulators sought advice or did a consultation of the industry to set standards as to ESG indices sold to in retail structured products. So it was a long process for sure, but it resulted in a common set of standards which were easily adopted. So that's for the process. And in terms of the contents, the objective was not to define a very rigid, strict standard as to what an ESG index was or was not. It was more about designing rules and standards for filters or transparency. And so with this standard, you don't hinder future innovation or new themes, and you can still address different clients' demands. So it's still flexible enough.
Maybe next question for you, Johannes. Do you think that in structured products, ESG is now the norm? And if not, then what will it take for sustainable products to become the norm? And it's maybe a question open for all of you.
There's like two ways you can think about the question. First of all, does it become a benchmark to invest into ESG kind of indices? And the second, like if it's a benchmark, which index is going to be the new benchmark? So first of all, let's see from the kind of requests that we receive from clients in terms of new index creation, I would say from the European countries, say Germany, Italy, France, Belgium, Nordics, 80% of the indices have some kind of ESG filter to them. And even in other industries where you wouldn't really expect it so much, there's a lot of demand for these ESG kind of things. We did some research survey the other day where we asked hedge funds if they see a lot of demand for this ESG kind of investments. And basically you would think if you're an investor in a hedge fund, all you care about is making money and you don't care so much about the ESG angle. And actually they found out that 60% of clients of investors actually ask about ESG, whereas only 21% of hedge funds actually are able to offer some kind of ESG kind of thing. So I think there's still some flow to come also from the hedge fund kind of industry. Now, the other thing, which is also very interesting, is what is going to be the new benchmark. So you already have like a lot of benchmarks out there. You have the Euro STOXX, you have the S&P 500, Nikkei, and so forth. And I think all index providers would love to have like the next ESG kind of benchmark kind of index. But why is the Euro STOXX the benchmark index in Europe? Is it because everybody thinks that the selection of stocks is the best possible? Is it because the performance is so great? No, it's just because of liquidity. You can trade like a 10-year product on Euro STOXX as an investor and you'd pay like 10 basis points, 15 basis points to get in and out. And you can say about the financial industry whatever you want, but I think this is one of the great achievements that we are able to create such products which are completely or very, very cheap for our kind of clients. Now, if you look at ESG indices, there's a lot of indices out there. That's mainly because everybody thinks differently about ESG. I think there's 130 ESG ETFs out there in Europe. And each of them is somehow like expiring to become the new benchmark, but of course it can only be one. One very good thing that STOXX did now is launching this ESG futures. Because it's always a little bit of a chicken and egg kind of thing. Like you need to have the liquidity to be the benchmark and the other way around. So STOXX somehow laid the egg now. Let's see if the chicken is going to follow.
Hopefully.
No, if I may add as well to this, I think the problem so far is that obviously there are different kind of guidelines that follow the same ambition of basically promoting socially responsible investments. But among the criteria that are being used, there are some of them that could be, let's say, disputable. So think about the nuclear power. So basically for some people, that is negative and that should be excluded from, let's say, a benchmark ESG index. But for some other people, for other investors, that could be seen as positive, replacing traditional source of energies. And so basically there are a lot of questions that need to be solved before actually a benchmark can be out in the markets. Obviously, because of all those quite strict rules that needs to be considered, there could be some liquidity questions that could arise.
So, final question, maybe before we open to some questions from the room. Are you, in your different banks, taking some kind of proactive stance to in positioning some ESG strategies or products, and do you have some kind of educational strategies when it comes to ESG? Maybe for you, Michael, to start.
Absolutely. Maybe first, I'd like to highlight that Credit Suisse has set up recently a transversal department across the bank that is responsible for sustainable products. And so this department specifically is responsible for ensuring that Credit Suisse is selling properly and is marketing properly ESG investments. So indeed, we are pushing actively for ESG products to our investors, even the ones that do not necessarily ask for it. Obviously, Credit Suisse has quite an important wealth management business, and so that's where we are pushing quite strongly. I mean, as Isabel mentioned before, so a structured product is a combination of a fixed income instrument and an equity or a derivative option. So here the idea is to offer products that are ESG, but not only at the equity level, but also at the fixed income level. So as part of the different initiatives that have been taken to offer ESG products to our investors, for example, we are proposing some repackaging of corporate green bonds. We are proposing some products issued by supranational entities like the IBRD or the World Bank, as well as different products where, for example, the issuer is well ranked with regards to different ESG criteria. So indeed, yes. I think this is an important topic for the bank, and indeed it resonates quite well with our private bank business.
Yeah. I can only repeat what my colleagues see. So at JP Morgan, of course, ESG is a big thing for us, and we take it very seriously in a broad different kind of business spectrums. One thing that we do, for example, is also speaking with index providers like STOXX, trying to help them build the right indices, help them understand what kind of ESG indices are needed by the client base, and help in that regard.
Yeah, I would just add that to me, education here is the key word and role that banks should play. So, to me, to further develop ESG adoption, there's product innovation, of course. The second one is clarification of the offering, and the third one is education. So what do we do? How do we spread the word? I think on the index part, it's a lot about taking the time to explain what ESG factors are and how they can be relevant to generate positive performance alongside societal or environmental impact. And there, I think the role of research is very important. So at Société Générale, we're lucky to have a 12+ year ESG research, which was very well recognized with Excel. And I think that's a key asset. So to me, often you will need to first have meetings with research before you start discussing solutions. And you need to make that time. Before you start discussing products, you discuss what it is about. So that's, I think, the very important piece for education around indices. And then at the level of products, so as I mentioned, we promote positive impact finance with the United Nations because it's an initiative from the UN. It's about financing, as I briefly mentioned, it's about financing projects that have a positive impact on all of the sustainable development goals potentially, or at least, environmental and social. We strongly believe sustainable investment is green, but also, about social impacts like education or health, to just name two. And to do that, there's a huge effort of communication using, all types of means available. So it's, of course, one-to-one and one-to-one meetings, group teaching. It's about, video, press, media attention. you should leverage all you can to do this education. And I agree it's a collaborative effort from the bank because obviously, this stems from us on the market side, but also our colleagues who originate the positive impact financings. So I really concur with what Michael said regarding, that support to sustainable financings and the education is a joint effort.
Thank you. I've just checked the app. I don't see any question on the app, but maybe there is, or there are some questions in the audience. No. Then we are getting back on the agenda as promised. Yes.
Thank you very much. So you were saying that there's a demand, but there's not enough of supply. What is holding back the supply, do you think?
You mean like on the hedge fund kind of side?
Yeah.
So I think for hedge funds, it's a bit difficult. Like the way their models work historically is basically to understand like how can they generate alpha, what kind of stocks can they buy in order to generate or to outperform some kind of a benchmark. And I think it just takes some time for them to incorporate ESG kind of filters into that, into their kind of models. And additionally, out of the 20% of the hedge funds which actually offer some kind of ESG kind of product, only 9% said that they think that ESG actually generates some kind of alpha. So basically, I think it's a little bit of a contrarian kind of thing for hedge funds to incorporate this ESG angle into their strategies.
I think it's also about time horizons. I mean, if you're trying to generate, performance in the very short term, as you would expect generally a hedge fund to be doing, maybe there's still more work to do with the ESG factors. Traditionally, those have been used to generate positive risk return in the medium term. So it might be a second reason.
Nico.
Yes, there's a lot of regulation coming on the structured products market as well. What do you foresee, as the biggest, hurdle for implementing those structured product strategies?
So I think for structured products, especially, one of the main questions is about pricing efficiency. And so when we think about an index or a strategy that should be the underlying of the structured products, usually we face some pricing considerations. And so I think that's one of the key topics. There are some regulators that are preventing the design of too complex indices. And that is, to some extent, jeopardizing the potential for having indices that do work for traditional structured products.
Hi, Sital Chima. Just in terms of hedge funds, can't you actually double up your chances of alpha? So not only can you buy high ESG scores companies, but you can sell short those with low ESG scores. But I take your point, it's all about the term. How long are you prepared to hold them? And hedge fund investors may be more short-term than long-term pension investors perhaps. But you can actually generate alpha by doubling up your alpha chances.
Yeah. Yeah, I think that's one of the strategies which hedge funds will try to apply in the future. I think like basically just the way they have implemented their models in the past is basically not just taking this ESG data so much into consideration, and more looking at other kind of factors.
And I think they would probably start, just for the sake of price efficiency and trading efficiency, they would probably start going long the well-rated stocks and short the benchmark before they go to short the SIN stocks.
I think I saw another question in the middle. The mic is coming. Next.
With regulators preventing complex structures, do you think there'll be an increase in capital protected structured products?
I think it will depend a lot of the rates market, no? So if you have rates going up, you will be able to afford more of these capital protected kind of structures. But with European rates being as low as they are right now, it's very difficult. Like I see it a lot in the US, like we at JP Morgan, of course, have a very big business also in the US. And there the amount of capital protected structures is around 80% or so, just because US rates are so high. Whereas in Europe with 10-year rates at 30 bips or something, it's very complex to offer something.
And I think you need to distinguish between risk level and complexity. So, you know, the risk, I mean, you could offer a structure that's capital protected or one that, you know, yields more. And as long as this is very clearly explained to investors, you know, regulators are usually satisfied. I mean, they have already sets of rules, irrespective of ESG, to make sure this is done well. That's for you know, the level of risk. With regards to complexity, and the example I gave of the French guidelines for ESG indices sold to retail, this was really about tackling the complexity and making sure that these indices were simple enough to be sold to and explained to retail. So then you can use them in a riskier product or in a capital protected product, but that's a different topic, you know, complexity and risk level.